Hello everyone, I am William. Welcome to this channel and thank you for being here. If you found this channel is useful, please feel free to subscribe and switch on the notification function. Today, we will be navigating the complex but critical world of derivatives trading audits. We'll unpack why these audits are essential, what they focus on, and how they protect institutions from financial, operational, and reputational harm. Here's our roadmap. We will start by understanding the unique risks inherent in derivatives. Then, we'll move to the core pillars of the audit, covering valuation, operational controls, compliance, and counterparty risk. We'll examine key tools and techniques, briefly touch on a case study, and conclude with the evolving regulatory landscape and our key takeaways. Our objective is to give you a clear framework for understanding the scope and necessity of a robust derivatives audit function. First, let's establish context. Derivatives, be they swaps, options, or futures, are powerful tools for hedging and speculation, but their complexity is a double-edged sword. Key risk drivers include high leverage, where small market moves can cause large losses. Complex valuation models often reliant on unobservable inputs, long settlement cycles increasing operational risk, and intricate legal documentation like ISDA agreements. The 2008 financial crisis was a stark reminder of what happens when these risks are unmanaged and unaudited. Therefore, an effective audit isn't a single check. It's a multifaceted examination built on 4 pillars. 1. Valuation and fair value accounting. 2. Operational and trade lifecycle controls. 3. Regulatory and compliance adherence. And 4. Counterparty credit risk management. Let's delve into each. Pillar 1. Valuation and fair value accounting. The mantra here is, if you can't value it, you can't manage it. Our audit tests the integrity of pricing models. Are the models appropriate for the product? We scrutinize the inputs. Are market data sources reliable? For level 2 and 3 assets, how are unobservable inputs like volatility or correlation determined? We verify the model governance process. Are there independent model validations? And crucially, we test the end-of-day marking process and the management of day-one profit-loss recognition. The goal is to ensure the P&L and balance sheet reflect economic reality. Pillar 2. Operational and trade lifecycle controls. From trade capture to settlement, errors are costly. We audit the pre-trade environment. Are there approved product lists and trading mandates? At execution, we check for accurate, timely, and complete trade capture. The confirmation process is critical. Are affirmations and confirmations exchanged and reconciled promptly? We review collateral management. Are margin calls calculated, issued, and received correctly? Finally, we look at settlement. Is there fails management? This end-to-end review ensures operational resilience. Pillar 3. Regulatory and compliance adherence. The regulatory web is dense. Key focuses include Dodd-Frank/EMIR, clearing and reporting. Are trades reported correctly to swap data repositories? Are clearable trades being centrally cleared? Margin rules. Are initial and variation margin requirements being met for non-cleared trades? Position limits. Is the trading desk adhering to exchange set limits? Conduct risk. Monitoring for market abuse, ensuring best execution, and managing conflicts of interest. Non-compliance here leads directly to severe penalties. Pillar 4. Counterparty credit risk. A profitable trade is meaningless if the counterparty defaults. We audit the credit approval process. Are limits set based on sound analysis? We test the calculation and monitoring of credit exposure metrics like potential future exposure and expected positive exposure. The effectiveness of netting agreements is key. Are they legally enforceable across jurisdictions? And we assess the quality and liquidity of collateral held. This pillar safeguards the balance sheet from a domino effect of defaults. How do we perform this audit? We move beyond sampling. Data analytics is now central, using scripts to analyze 100% of trade populations for outliers or pattern breaks. We perform independent price verification by sourcing quotes from multiple brokers. Process walkthroughs with front, middle, and back office staff reveal control gaps. We reconcile data across systems, from trading platform to risk system to general ledger. This toolkit allows for a risk-based, deep-dive approach. A real-world example crystallizes this. The 2012 London whale incident at J.P. Morgan Chase involved complex credit derivatives. The audit failures were multifaceted. Valuation. Traders used marks that hid losses. Risk controls. The CIO's value-at-risk model was flawed, understating risk. Governance. Oversight committees were not fully informed. A robust audit would have challenged the model, verified the marks against independent sources, and escalated the breach of risk limits. The result was a $6 billion loss and lasting reputational damage. The audit must evolve with the market. Key trends include climate risk derivatives. How are ESG-linked swaps audited? Crypto asset derivatives, addressing extreme volatility and custody risks. Increased automation and AI, auditing algo-driven trading and black box models. Global regulatory fragmentation, navigating differing rules across the US, EU, and APAC. The auditor's skill set must now include data science and the understanding of emerging product structures. In conclusion, a derivatives trading audit is not a compliance checkbox. It is a vital value preservation activity. To reiterate, 1. It is multidisciplinary, requiring market, credit, operational, and regulatory expertise. 2. It is model-centric. Challenging assumptions is paramount. 3. It is increasingly data-driven, relying on forensic analytics. And 4. It is forward-looking, adapting to new products and technologies. Ultimately, a strong derivatives audit function provides assurance to the board, confidence to regulators, and protection to shareholders. It ensures the complex machinery of derivatives trading runs smoothly, transparently, and within the bounds of prudent risk. Thank you for your time and attention. If you found this video as useful, please do share it out with your friends, your colleagues. Also, please feel free to subscribe to this channel. Thanks again, and have a nice day.